Hello everyone, my name is Neil Bawa. I'm your host today. That's my picture up there to the right. Today we're here to learn about multifamily fundamentals. These are the foundational concepts, the benefits that you will get from apartment investing, from learning either to invest passively or to lead deals that others can invest in. We've got a packed agenda, but first let me start with a disclaimer. Our lawyer insists that I read this whole thing, so I'm going to do that. We're not investment advisors, and this webinar is provided for educational purposes only. All investments involve different degrees of risk. You should be aware of your risk tolerance level and financial situation at all times. Read all investment docs carefully before making any investment decisions. All info should be researched prior to investing any money. You are free to accept or reject all investment recommendations made by us. All services that we offer are subject to market risk and may result in loss to your investment. As you know, a recommendation is not a guarantee for the successful performance of an investment, and we cannot guarantee against losses arising from market conditions. Do not invest your money on our recommendation alone. Consult a professional advisor. All right. Having gotten beyond the legal stuff, let's talk about our goal for today. But before I do that, I want to point something out. I'm not a presenter that wants you to write questions down and wait until the end. There's many of you on the webinar today that will have questions come up. As they come up, fire away. On my side, I get a blinking blue box, and it takes me a little bit of time to notice that. But whenever I do, I'm going to click on that, read the question, and answer it as I go. So let's make this as interactive as possible. So let's start with our goal for the day. We're going to start with the big why and the how. Why should we be looking at multifamily investment? And then we're going to talk about the how. We're going to introduce you to the $2+ trillion, that's $2,000 billion U.S. multifamily market. We're going to talk about the latest market trends that are driving multifamily growth, the explosive growth that we've seen in the last 3 years. We're going to explain how groups of investors buy multifamily properties together. Typically, no one buys multifamily properties by themselves, and we'll explain how groups buy them. We're going to discuss the top reasons to invest in multifamily, not the trends, but the top reasons that people have been using for the last 150 years to invest in multifamily. We're going to quickly go through the life cycle of a multifamily project, and we're going to do a 2016 update. Rents, cap rates, metros, inventory, risks, and predictions. Again, this is going to be a very short update at the end for 2016, and then we'll do a quick review. As I mentioned, fire away on the questions as we go along. All right, let's get started. So obviously, we invest in multifamily, or in real estate for that matter, because we want yield, we want return. So it's very important that before we start talking about multifamily itself, we really talk about the big why and the how, right? And those are the questions that are very important, and I'll ask them, and I think you'll see why. So the first why is, why can you not afford to only, emphasis, only invest in stocks and bonds? Why must you seek higher yield safely? I'm going to answer both of these questions in a minute, and I'm going to add a how. How can you invest in real estate passively? No management, no rehab, no flipping. So let's look at the why and how. So really, the answer to the why is staring us in the face. America's Social Security and retirement planning system was designed for a completely different reality. And there are 3 very important reasons for this. Number 1, life expectancy. So your great-grandfather basically worked until the day he died. He died at the age, or on average, at the age of 49 years in the year 1900. But your grandfather, on average, would live to be 69 years old, right around 1960. So this has gone up about 20 years. So retirement then had to last a few years. And if you remember correctly, this is when the Social Security system was created, when retirement just had to last a few years. Well, now we're at 79 years and rising fast, 83 for women, and now your retirement has to last decades. And due to advances in medical technology, I do not believe that this number is going to go down. It's going to go up further. Well, that means that Social Security, having been designed for this number, now has to contend with this number. Number 2, healthcare costs are rising way faster than inflation. How much faster? This much faster. So you look at gross domestic product down here, you look at GDP and wages, and then you look at the cost of healthcare. And notice that most of the cost of healthcare is in the final 2 decades of life. Number 3, my favorite, stock market returns when adjusted for inflation are really just too low to get ahead. Well, how low are they? So what is the actual annual growth over the last 14 years? Not some little piece that I would have picked saying, okay, well, this is a low one or that one. But let's just look at the last 14 completed years. I'm sorry, I haven't adjusted this for 2015 yet, but it's going to look much worse if I do. So if I invested a certain amount of money in Jan 1, 2001 and went all the way to 2014, and I adjust for inflation and I include dividends, guess what? My annualized return or true CAGR is just 2.99. If I add 2015, it's going to drop even further. What does that mean? If I invested a buck 14 years ago or 15 years ago, that buck would have just grown to $1.51 by now. $1 becomes $1.51. By the way, if anybody wants to know where this calculation is coming from, just look at this. So if you're only growing your stock market revenue or wealth to the point where it took 14 years for a buck to grow to $1.51, well, how is it possible for this money to be sufficient for retirement? It's not going to get there. So what do you really need to do to get ahead? What do you need to do to get to the point where you have a sufficient passive income so you're not totally dependent on Social Security? Well, you need to understand the magic of compounding. Compounding is a very powerful thing. And then you need to add investments that have potentially higher yields to your portfolio than stocks and bonds or CDs. Well, the math will show you just how amazing this is. This is an astonishing difference. So pay attention. If you invest $100 for 30 years at 3 different levels of returns, well, what do you end up with at the end of the 30 years? So if you invest $100 at 2%, well, that 100 bucks will become $182. If you invested at 10%, now it's grown. It's grown from 100 bucks to about $2,000. But if you invested at 18%, that $100 is now $21,000. Now keep in mind, most people, if asked to draw a graph, would have drawn it like this. But the magic of compounding returns means that yields do not go up like this. They go up like this. They go up in what is known as an exponential curve. This is why it's very important that along with stock investments and bonds, you have some investments that have the potential for higher yields, because at 18%, look at the astonishing difference between these bars. Now, put another way, if you want to look at the end goal in mind and you want to have $15,000 per month in passive income 20 years from now, that may sound like a big number, but keep in mind inflation, right? 15,000 years will buy a lot less in 20 years. How much do you need to save each month? Well, if you were investing at 2%, believe it or not, you need to save $30,000 a month. I know that's a laughable number, so let's look at 10% returns. Well, now you need to still save $2,370 a month to have this much in passive income. What about 18%? You need to save $400. Once again, this is an exponential curve. This is why it's very important for you to consider potentially higher yield and higher risk, so keep that in mind, investments, and add some of those to your portfolio. Real estate represents such an investment, and multifamily in particular represents one that has potentially higher yield than stocks and bonds. So with that in mind, let's learn about what I do, what Financial Attunement does. My company, my partner and I, John-Mark Landau and myself, we're passionate about having your assets work for you, fine-tuning your thinking about capital and investing. And did you notice? I did fine-tune your thinking in the last 10 minutes or so. I have a question, so let me see. I have a hand up. Instead of putting a hand up, please just type in your question, and I will be happy to answer it as I go. Okay, let's get back to this. So we buy and manage multifamily complexes nationwide. Our company at this point has 1,001 units, and these units are in primarily in Texas and in Illinois. These are the states that we own in. As I mentioned, the biggest ones are Texas and Illinois, but we also have Oklahoma and California. The soon no longer applies to Illinois. We've completed that purchase. Our competency really is in asset selection and management. So we focus on buying underutilized assets in really good markets and then really managing those assets well. And we've got decades of real estate experience. I've been at it for 10 years. The last transaction we completed in Illinois, in Chicago, was my 38th transaction. John Mark's been at it since 1982. So he's been a loan broker and funded over $1 billion in loans, over 3,000 different transactions. So a lot of experience. Oops, we seem to have this slide again, so I'm going to skip right past that. Okay, before I get started, I'm going to take a question. All right. So a question is from Trevor. Compounding sounds like what happens when you let interest accrue, not what happens when your real estate appreciates. How does the concept of compounding apply to buying and holding real estate? Well, Trevor, in this case, it applies because you tend not to want to hold on to that real estate for 20 or 30 years. Your goal is to make each of your real estate investments 2, 3, or 4 years and then reinvest it. So it's not compounding annually, it's really compounding at an average of one investment per 3 to 4 years. But then obviously you can sell that investment and spend that money. But what we're proposing is don't. Make that investment compound, and over a 30-year time frame, you should see spectacular results. Hopefully that answers your question, Trevor. All right, so now let's get started with multifamily. Let's learn the basics of multifamily. So what does the term mean? Well, generally it means 5+ units, but it reaches true economy of scale at 150 units. Now, 1 to 4 units, technically a 2-unit, a 3-unit, and 4-unit are multifamily because it's more than one family living in there. But they're treated as single family, and you get residential loans, which have a lot of disadvantages. So when tradespeople talk about multifamily, they're talking about 5 units or greater. I have another question, so let me take that. All right, so that's just a smiley face from Trevor. Haha. Let's see. I'm going to keep going. How are multifamily properties valued? Well, they're very, very, very different from how single family is valued. They're valued based on NOI, or net operating income. These are not based on comparables. What does this mean? Well, firstly, it means that you could have 2 identical multifamilies sitting next to each other, all built in the same year. They look exactly the same. They're in the same condition. One could be worth twice as much as the other. Would that ever happen in single family? No. But because one of them has twice the net operating income, it could potentially be worth twice as much as the other. Here's an example. This is a really good example, and this slide, by the way, this is the most important slide. So pay careful attention. The magic of multifamily is right here. In a 200-unit apartment complex, the management successfully raises rents by $25 per unit. The value of that property goes up immediately by $750,000. This happens every time. 200 units multiplied by $25, multiplied by 12 months, divided by 8% cap rate. This is a standard method used in the US to value multifamilies. This number becomes $750,000. So if you raise the rents by $25 per unit, you've raised the value of a 200-unit building by $750,000. Let's talk about loans. Loans are actually not based on your credit. They don't even check your credit. They're based on the property's operating income and the occupancy, not on your income, not on your credit, which means that somebody who typically wouldn't qualify to get a single family can buy a 100-unit as long as that property has sufficient income. Now, this is very important, the second part. As an investor, you have to know that the lenders are on your side. Unlike single family, lenders scrutinize each property in great detail. We have to submit 2 years of rent rolls. We have to submit 2 years of operating income, which really helps protect investors. The lenders really go to great lengths to ensure that we do not buy at too high of a price. Now let's talk cycles. So real estate has predictable market cycles, which creates identifiable emerging markets in the US. And savvy real estate investors, we know how to read these cycles and time investments accordingly to enter and exit markets. For example, right now, you've got markets, some markets like Sacramento right here, San Francisco is up here, Dallas is roughly around this area here, and Houston has now turned the curve and has experienced a 7.5% decline in the last 6 months. So it's right here. So what our goal is not to buy here, not to buy here. We want to buy right around here. That's our goal. And we also want to exit here. We do not want to wait for a market to reach its maximum height. We tend to exit before that, so we leave some meat on the bone as we enter and exit markets. How long is an investment for? Well, a typical multifamily investment is 2 to 7 years. In the last 3 years, multifamilies have been doing spectacularly well. Results have been amazing. Returns have been absolutely astonishing. So it's been closer to the 2 to 3 year mark. But I think in the long run, it's going to return back to the 5-year or 7-year time frame that we've seen in the last 50 years. Why are multifamily values generally less volatile than single families? Well, because values are based on income. So if all of a sudden a recession starts, well, single family values are going to decline at that point in time. Multifamily, these people still have to live somewhere. And in many metros, you actually gain from a recession because people that owned single family homes can no longer afford them. So now they have to jump over into multifamilies. This is not true of Class A multifamily, but it's very true of Class B and Class C multifamily. So people still need a place to live during recessions. So rents tend to fluctuate less than home prices, and so therefore multifamily values are generally less volatile than single family values. So a lot of people that have been to multifamily seminars have heard these terms Class A, Class B, Class C, but they don't really know what these mean. So I'm going to go over them quickly. So these are the most prestigious buildings, Class A, average, affluent tenants, above average rents. Buildings are generally newer, I'd say newer than 15 to 20 years. High quality standard finishes, usually granite countertops, steel appliances, great amenities. So they have gyms, pools, usually tennis courts. And there's no deferred maintenance, meaning when something breaks, they just fix it immediately. The problem is low cash flow and upside for investors. So cap rates right now have even gone below 3-4%. So in California, you see cap rates of 3.5% to 5% for Class A buildings. Most buyers are institutional investors. They don't need cash flow. They invest for the long term. Cash flow of Class A's is the most sensitive to recessions. B, these are buildings competing for a wide range of users. Average rents, a bit older than Class A, I'd say usually between 15 and 35 years old. Finishes fair to good. There's always some deferred maintenance. Amenities are adequate. They all tend to have gyms, and they all tend to have pools, but not much else. Better cash flow than Class A. Cap rates, typically these have dropped again now to 5 to 7, 5 to 6.5, I should say, and a mix of institutional and private buyers. So private buyers such as us do buy Class B properties, but then the institutionals now are also getting into the picture because they also are having trouble tolerating cap rates of 3.5%. Class C, now these buildings are typically, I would say, older than 25 years old and located in less desirable locations. You'll never see a Class C in downtown San Francisco or downtown Oakland. They're, I would say, always in need of renovation and updating. There's always something that needs to be updated. Rents are lower. Now there's a higher level of mismanagement here because very often rich people buy Class C buildings on their own, and then those buildings get mismanaged. I love those kind of buyers because that's who we tend to buy from. Cap rates tend to typically be at 7% or greater. Think of a cap rate as if I invest $100 cash and I don't get a loan, I'll get a 7% return. That's more or less an understanding of what a cap rate means. So a higher cap rate typically means a higher cash flow. So highest cash flow and the greatest upside now, but keep in mind that the B's and A's will probably appreciate more in the long run, let's say 10 years or greater. There's also Class B, which is don't buy. These basically are war zones and not our market, so I'm not going to cover it. All right, so now let's talk about multifamily trends. This is stuff that's 10 years or less old, trends, and these are driving the explosive growth in multifamily, the amazing profits that we've seen in the last 4 years. which I believe will continue for the next 10 years. Here's why. Number one is that a fundamental change is taking place across America, and that is that rent is the new buy. Americans all of a sudden prefer to rent, and the younger Americans prefer to rent more than the older Americans. This is driving long-term demand for multifamily properties. Only half of all renters said they anticipated becoming homeowners in the next 5 years. This number is the lowest ever that since polling started, and this poll, by the way, is from the Wall Street Journal and from Appfolio. They're not buying homes even if they qualify. So less than 1/3 of renters said it's not that we cannot get a mortgage. There are other reasons for us not becoming homeowners in the near future. And this is why. Well, they want good schools. They want safe neighborhoods. They want parks and playgrounds, community centers, and friendly neighborhoods. And they're getting priced out of all of those. So they're liking the freedom of the renting lifestyle. Also, a particular group of people, the millennials, are clearly not buying homes at the same rate as the previous generation. So millennial purchasing peaked at around 17.5% in 2005 and has now been declining. It has continued to decline in 2015 and 2016. It's now roughly slightly below 13%. Also, the baby boomers are beginning to downsize, but instead of downsizing to smaller single-family homes, they're downsizing to urban apartments. There's 75 million of these people, and they're basically going to urban apartments. Maybe they're moving closer to their kids who live in the city. Maybe they want the convenient services and the easy access to amenities. It's not quite clear why, but a lot of these baby boomers are going to urban apartments. And as a result, you've got this runway. It's astonishing, and anyone who's been in multifamily knows just how amazing the last 3 years have been. 2015 saw nationwide rent increases of 5.5%. Keep in mind, the historical standard is 2%. 2014 was almost as good, close to 5% rent growth. 2015 is forecast at between 4 and 5% rent growth. These are amazing, amazing numbers and mean an extraordinary once-in-a-lifetime opportunity for investors. And so you looked at the trends, you saw how those trends are impacting America's decision-making when it comes to rental homes versus single-family homes. So now let's show you how you can benefit from these trends. So buying together, how do groups of investors buy multifamilies? Well, they buy through this concept called syndication. So multifamilies are expensive, so a bunch of people get together. They use a mechanism called syndication. The rules are governed by the Securities and Exchange Commission for the Protection of Investors. So this is an area that is tightly controlled. And what happens is a multifamily syndication team finds an asset to purchase, then offers the opportunity to their investors, who then choose to participate or not. Individuals can participate, self-directed retirement plans like 401ks and IRAs, or entities, LLCs, can invest varying amounts, and everybody gets a proportional equity share of both the cash flow and the value gain. The syndication team, a team such as ours, finds and they contract to purchase, they do all the due diligence, they organize the offering, they pool the funds, and then they manage the property until sale, which typically happens 3 to 5 years later. For making the opportunity available to investors, they get a share of cash flow and profits, and they get a small management fee. Typically, the split between the team and the investors is 30-70. So the management team then assigns an asset manager and a property management company to run the property. The management team doesn't run the property management company runs it. There's usually also a local asset manager. For example, our asset manager in Chicago is a gentleman named Ethan who lives about 20 miles away and has a lot of experience in real estate. Investors have no involvement in day-to-day running of the properties. No tenants, no toilets. I don't do tenants or toilets either. The cash flows are typically dispersed quarterly to investors who often, and in our case always, receive preferred returns before the management team is paid. And this is very important. I want to highlight just how important this is. When you invest your 401k, even if your 401k goes down in value, you still pay the same fees. If they go up in value, you won't pay any more. But the key thing is the fees are really fixed. The beauty of syndication is that you receive preferred returns before the management team is paid, which means that if the management team doesn't do their job, they don't get paid. It's pay for performance. All right. So though that was a little bit about syndication, now I'm going to tell you why you should invest in multifamily. Now you might say, well, didn't you already tell us this? You talked with us about trends? Yes, but those trends are less than 10 years old. But people have been buying multifamily properties for 150 years. Why have they been buying them? Let's look at a question. So here's a question from Ricardo. How is syndication different from real estate crowdfunding? Well, the answer is, in some ways it's similar. In many ways it's similar. Keep in mind that crowdfunding has hundreds or thousands of investors that are going into a single property, because very often you can invest as little as 5,000. What happens with syndication is most investors tend to be local, and the amount of information provided by the syndicator is much higher than you would get in a crowd-funded environment, because the local investors, constant phone calls, you've got a very personal feel and a very local feel to syndication, which you cannot get in real estate crowdfunding, because in most cases, those companies are not even in your metro. Here are my top 6 reasons to invest in multifamily. There's a lot of reasons, but these are my top 6. Number 1 is really cash flow. If it's not cash flowing, don't buy it. They need to generate enough income to cover cost of operations, your CapEx improvement, your financing, and money that needs to go into your pockets. You need to get all of these, not some of them. Exact returns will depend, but double-digit annualized returns for cash flow are pretty common. They're happening all the time in the U.S. in thousands and thousands of different projects. Number 2, forced appreciation. Remember that powerful slide where I said a $25 increase increases the value by $750,000? That's what I'm talking about when I say forced appreciation. If you double the profit, you double the value of the property. You don't have to wait for the market to catch up. You simply have to do your job well. So even with mostly stabilized properties, if you optimize the management, optimize upsells, you can get big returns while enjoying the cash flow from day one. Now, the more distressed a property, you'll get a deeper discount to value on purchase, but you're also taking a greater risk, right? So working with stabilized properties and micro positioning, where you're not turning around a property or you're not taking an empty property and filling it up, gives you, that's a lower level of risk. So make sure that you're working with experienced managers and rehabbers. My favorite, I was a chief operations officer of a 350-person company for 17 years. And what I cared about was professional management and metrics. What I see in single family, which I've never seen in what I've seen in multifamily that I never see in single family, is professional management and metrics. So there are metrics in every area. For example, in leasing, there is a metric chart called LASAL, L-A-S-A-L. And it really, because there's 5 steps of leasing: lead to appointment, appointment to show, show to application, and application to lease, LASAL. Well, this flow or sales funnel is well understood by property managers, and so everybody that's involved in the leasing process has to follow a certain set of metrics, and if they don't do their job, they're out the door. You will never see this kind of thing in single family, and that's why the returns typically are higher. Inflation protection, right? So single family and multifamily both work for inflation protection. We're in an environment where every single central bank in the world is in a race to the bottom to debase their currencies, and when you do that, at some point you will invite hyperinflation. I don't believe that we're more than 5 years away from hyperinflation, which is why I feel that everyone must invest in real assets such as single family, multifamily, and gold. Tax benefits. So multifamily properties are able to take advantage of depreciation on the building. So it's not abnormal for you to invest $100,000, get a $10,000 check in your bank each year, but for the purposes of taxes, your K1 only says $2,000 or $3,000. This is just an example, but it's a fairly typical example. And you might say, how is that? Well, that's due to the magic of depreciation. Economies of scale, another one of my favorites. This is why I have been actively selling my small multifamilies and my single families because I love the economies of scale that come from multifamily. You've got a rental office in one place, you've got one leasing agent that is selling 150 or 200 or 300 units at one time. Marketing is so much more efficient. Repair and maintenance is more efficient because all of those folks are your full-time employees. So you keep moving them around and closing your repair tickets. And you can carry out upgrades with less impact because even if you're at 96% occupancy on a 200 unit, that still leaves 8 units down. And you can be repairing and fixing and upgrading those 8 units and still maintain an extraordinarily high level of occupancy. Okay, now let's move on to a very, very quick life cycle of a multifamily project. So I'm going to go through this at blazing speed, and I apologize for that because today I'm going to give you a bonus, which is 2016 trends. So here's the life cycle of a multifamily project. There's 4 phases: pre-offer, post-offer, post-purchase, and sale. Pre-offer, a lot of work. Metro research, where are the jobs? Where's the path of progress within that metro? The path of progress is like a river. It flows across a metro in a certain direction, and you don't want to be inside the path of progress. You want to buy ahead of it. So if the river is flowing northeast, you want to buy a mile or 2 miles away from that path of progress, but in that path. So pricing trends, right? Where are the prices rising, but they haven't risen so much that you cannot get reasonable amount of return? Then you start creating your team, your realtors, inspectors, property managers, contractors, so you've got reliable people in that metro. And then you start doing opportunity search within the target areas that are in the path of progress. You walk all the comps for sale in the target areas so you can really educate yourself on what people are telling you when they're selling properties and what are they selling them for. And then once you start finding your opportunity, you make a first offer, which is based on the seller's financials and is almost always not the final offer. So the seller gives you a bunch of financials, you look at them, and you say, okay, fine, I'll make an offer on this. But then you go in and start doing a 3-phase due diligence process. Phase 1, roofs, sewers. You send cameras down the sewers, you look at repairs, you look at the conditions of all the different units. Do you have to change carpets? Do you have to paint the hallways? What about the exteriors? Do you have to do tuck pointing? Will the electrical work, or will the city force an upgrade? What about the plumbing and the mechanical? You verify the financials, right? Are they just giving you some crap, or are these real financials? Are rents really where they are? What about occupancy levels? And what about delinquency? Do people actually pay? What use is an apartment complex that's at 90% occupancy if only 60% of those people are actually paying? What about staff competency? Are the property managers and leasing agents and maintenance people really doing their job? And then the third phase, now you go back and you walk comps again to ensure that the pricing and assumptions are sound and that the property that you're buying is a good buy. And then, this is the most important step, and you often get stuck here, you negotiate a repair credit. For our $12 million purchase in Chicago, we negotiated a $940,000 repair credit. That's almost, would say, 7 or 8% of the purchase price. So at this point, sometimes a seller says, no, I think I can still sell the unit to somebody else. I'm not going to pay you this much. Well, then, if the seller doesn't agree, you wasted a lot of time and effort, and you restart at phase 1. If the seller agrees, then you promote the opportunity to investors through webinars and detailed investor summaries and financial projection documents. In the meantime, the lawyers work on the multiple LLC structures that are needed to protect the investors and protect the management team. Typically, you finish your purchase within 75 days, and the property gets handed over to you. Then begins the fun, the post-purchase. Now you need to make changes to property management team, retrain, or replace. I can tell you, in our case, we tend to replace 90% of the time. Our latest property in Chicago, we've replaced the property manager, we've replaced leasing agent, we've replaced the maintenance staff. Management then starts making upgrades to amenities, interior and exterior. In Chicago, we're doing painting, we're painting the hallways, we're replacing the carpets, and we are upgrading a number of the units with new cabinetry. Management transitions out or evicts undesirable tenants and brings in better tenants with higher rents. Once again, Chicago as an example, we are planning to evict 30 out of our 237 tenants. So at this point, the court process is underway for roughly half of those 30. We're bringing in better tenants with higher rents. Chicago has been wonderful in that 100% of the contracts that we have signed since the time that we took over have been above our pro forma rents. Our pro forma is what we predict. That's what investors get to see. And we've been 100% of the time, our signed leases have been above that. And in most cases, they should be, because the previous management was doing a terrible job. So they were not really getting market rents. Then the repair budget, you start using it, and typically you spend most of it in the first 90 days. So for Chicago, I think we're actually going to spend the first 120 days because Chicago is so cold right now that no exterior work can be done until April or May. Each quarter, the investors receive checks for available cash flow, and they receive financials and a property report from the management team. You should also get a monthly call or a monthly blog from your investment team. And then sale. So now they've been running it for 3 to 5 years. Now the market's appreciating, so rents are going up. As I mentioned, 5.5% last year, almost 5% the year before. So there's market appreciation, and you're also managing it properly. So your rents are going up because a lot of your under market units are now at market or slightly above market. And the property's NOI, its net operating income, keeps going up. Well, typically by year 4, 5, or before, that NOI now reaches the exit projections that you gave your investors when you bought the project. At that point, you put it up for sale, and you complete the sale within a 6-month time frame. Investors first get their principal back, and then they get profits back, again with a 70-30 split, typical. All right, so that, in a nutshell, was the entire life cycle of a multifamily. Now, I promised you that this time multifamily fundamentals will be different because there's going to be a little bit of a teaser from my favorite presentation of the year, which is the annual trends for a year. I did that presentation on the 19th in Fremont, and I think a few of you attended that one. So this is going to be a little 5-minute revision for you guys. So what are the predictions from the analysts? What we do is we pool projections from CoStar, from IRR, from Goldman Sachs, and a few other analysts. And these are some of the predictions that they've had. So IRR, which is Integra Realty, they have 800 analysts, and they are multifamily experts. They're predicting outstanding performance 2015, followed by a high level of confidence. So they're saying it's difficult not to be bullish. Strong hiring numbers, a lot of momentum. Vacancy rates are down, but at this point, we still are not producing enough units to increase the current vacancy level in all of the markets. They're saying multifamily provided employment gains continue, the multifamily market will enjoy continued investment interest due to pent-up demand, current buy versus rent preferences. I want to highlight that, buy versus rent preferences, and the need to replace old post-war inventory. Here's prediction number 1 from PricewaterhouseCoopers. Many long-term investors aligned with an institutional investor who concludes that for the years ahead, we're still bullish on the apartment sector, though there are certainly markets with emerging supply issues. Houston, Raleigh, North Carolina, and Washington, D.C. being the top 3 markets with supply issues. Overall, we think that the demographic tailwind for rental apartments and continued urbanization is a longer-term trend that will make multifamily a good sector for a long time. This is what PricewaterhouseCoopers is saying. Cap rates, the prediction is stabilizing. They've been dropping, which means that returns have been dropping, but we expect them to stabilize for 74% of the major metros according to IRR. A small number of metros should see declines. DC, Houston, perhaps Raleigh, North Carolina will see small increases in the cap rate, which generally is not a good thing for investors. The investors, once you've invested, you want to see the cap rates continuing to decline. And this is how they've declined in the last, since 2010, where you see this was where the market was in a really bad place. And since then, declining cap rates mean increasing profits for investors. Rent growth. Here's the good news. Strong rent growth is expected due to overall demographic trends. So we were in 15, we were roughly around 4.5%, 5%, maybe a little more. I think this graph is not showing all of the rent increases, but keep in mind that these are spectacular numbers. For the last 50 years, 2% is the norm. So we're beginning to see heavy growth. Now some of it is going to go down in 2017, but in 16, we're still looking at a very, very high level of rent growth. Now keep in mind, most projects estimate rent growth at 2%. Our Chicago project estimates 5% for the first year, mostly because of the under market rents, and then 2, 2, 2, and 2. So if you start getting 4% rent growth, you're going to get much, much higher returns than projected. Which multifamily class will outperform? CoStar, which is a billion-dollar company with 1,500 analysts, says there's good news for Class B and C operators, and we are exclusively B and C operators. They've been insulated from vacancy changes. So in the last 2 years, the vacancy for Class A has actually gone up, which is not good news for Class A. This means they've got less units occupied. Now, notice what's happened at the same time in Class B and Class C. Their vacancy has dropped. Now, why is that? Because all of the new construction, all of it is in Class A. Nobody's building Class B, nobody's building Class C. So as a result, Class B and C continue to see vacancy declines, which is good for profit. All right, so once again, PricewaterhouseCoopers says that values in New York and San Francisco are just ridiculous. We see a trend in finding multifamily housing opportunities where costs are more manageable, looking more favorably to the garden apartment sector. What is garden apartment subsector? It's a sector where buildings tend to be 3 floors high. They rarely have elevators. Sometimes they do, but in most cases they don't. And so essentially, when you're buying a building, these buildings, again, they tend not to be above 3 floors simply because, you know, elevators are rarely provided. That particular sector is what investors are looking to, and that is the sector that we've always invested in. All of our 1,000 units are in the garden apartment subsector. We do not invest in high-rises. And prediction number 5 is supply, demand, and vacancy. You notice that there's going to be a slight uptick in vacancy, which is not good news for apartment investors, but keep in mind that we expect that all of this is in the Class A sector and not necessarily in the B and C sectors where we live. So bottom line really is economy is strong and will support rent growth in 2016. Having said that, the market's a little bit frothy, which is why growth will moderate. Almost every metro is in expansion mode, but many expansions are getting long in the tooth, and I gave you 3 metros that are really going to suffer. There will be a gradual reduction in average returns and yields as investors have bid up prices. So you're not going to get the sort of returns that you saw 3 years ago. Also expect some vacancy increases in most metros. This is going to vary from metro to metro, but the U.S. as a whole should see some vacancy increases because of higher rent prices. Do expect cap rates to stabilize and be very careful with your metro picks. All right, so we're through the presentation. Here's a recap. You learned about this massive market, $2,000 billion market. You now know about the trends. Remember those trends that we talked about? Rent is a new buy, millennials not buying as often. Those trends we talked about. We discussed the top 6 reasons why people invest in apartments: cash flow, inflation, you know, economies of scale, those sorts of things. Then we went through a life cycle of a project, and we went through that at high speed. Now let's spend 90 seconds on next steps. You know, if you like this, consider taking action. Here's an investment opportunity that is open to you. This is a 6-building portfolio. You look at some of the buildings on the right. To a cash flowing project in a neighborhood that has strong potential. We took over this property in December, so we've already completed this purchase. We have 41 investors. Over 90% of the money has already been raised. Demand actually came out to be way, way higher than we thought. We receive over 300 leads a month, and Chicago right now is fantastically low weather. We should be scheduled over 200 appointments a month, including over 30 just this week. Just yesterday, and today we've scheduled 30 appointments. That's 15 a day, and we receive over 50 applications a month. All of these numbers are actually triple the original projections. Initial rent estimates were very conservative, so the team's happy about that. All 30 of the first 30 leases that we've signed in January and in the early part of Feb are all above our pro forma rent. How much above? Minimum $25. Do you remember the magic slide? If a 200 unit has a $25 increase, you're looking at a $750,000 increase. Now keep in mind, we've only signed 30 leases, not 200. So we haven't quite gotten to the 750K. But what's nice is we're on track to be there within, I would say, the next 6 to 12 months. So our projected 18-month turnaround of this mismanaged property should now be completed in a year. So we're really spectacularly pleased about that. If you would like to learn more about this property and watch a video of this property, a 5-minute video that actually stars President Obama, he's building a library a mile from us, so we stuck that little piece in our presentation. Please write this down, www.financial-attunement.com/next. Now, there might be people who say, I don't want to invest in this. I'm just looking to learn. Yes, go to this page and learn how to put together a multifamily investment package. If you're actually interested in investing, write down this phone number or send us an email to info@financial-attunement.com. Now, apart from all this cool stuff about marketing and sales, why are we really into this project? Location, location, location. Here's our buildings. Hyde Park, where the President of the United States lives, has rents 40 to 60% higher, and they're pushing downwards. A mile south of us, a $4 billion project is being developed with 14,000 Class A dwellings. You'll see some of this project in our video. An entire city within a city is being developed in this area. These two areas are where the potential locations for the Obama Presidential Library, a $600 million project, which will involve thousands of permanent jobs. And then the University of Chicago, right there, a mile from us, is buying up homes for student housing and expanding their radius. All of this is creating intense pricing pressure, which is why all 30 of our leases have so far been above our projected numbers. That's why we like this property. Now, investment timing is very good. UBS, which is one of the largest banks in the world, shows Chicago is the only undervalued city amongst the world's top 15 cities. Bloomberg recently wrote an article warning against significant rent hikes when subsidized housing switches to market pricing. And South Shore, our neighborhood, was the highlighted neighborhood. Keep in mind there are over 5,000 neighborhoods in the United States, and they chose to highlight South Shore. Marcus and Millichap's report from last week, well, this is actually a couple months old now, raised their estimate of Chicago rent increases from 3.3 to 6%, and their estimate of vacancy also dropped very significantly. Both of these, very good news for us. So once again, we've raised over 90% of the money, over $3.5 million has been raised, and we have a few shares left. If you're interested, please let us know, and we will schedule a time to discuss the project with you. So that's it. You learned a lot about multifamily, and you learned about 2016 trends. Now, questions. I know this always takes a few seconds before the questions start coming, so start typing, and I'll answer all of your questions. First question is from Lonnie Gray. Careful in selecting metros. You mentioned Sacramento. What other areas in San Francisco Bay Area might be considered? Land is too high, but what about Class DC here? Lonnie, in general, I would say East Bay is better. Oakland was our pick for last year. I think that at this point it's getting a little bit frothy, but there's still room in the Bay Area, so I would say East Bay. Now, do I buy in San Francisco Bay Area? No, because it's not in my top 5. But there are a lot of people that want to buy locally, and I would say East Bay is your best shot. I would say areas like Brentwood will still continue to appreciate. Hopefully that answers your question. More questions? Where else in East Bay besides Brentwood? That's a hard question, Trevor. Let me think. I'd say Pittsburgh. So try Pittsburgh, try Brentwood. They're slim pickings because the Bay Area is such a aggressive market. There's so many rich people living here. It's difficult to find good places. But I'd say Antioch, Brentwood, Pittsburgh. Vallejo. Lonnie, the answer is yes, absolutely. But be careful. There are areas in Vallejo that are high crime. And high crime will prevent you from getting high valuations. So Lonnie had the same question. So it looks like a lot of people are interested in Vallejo. Yes, definitely Vallejo, but be careful about crime. How about Nevada or other low-cost metros? So the answer is my favorite presentation for the year is 2016 Trends. In that full presentation, which is 90 minutes long, I talk about every major metro in the U.S. This time, we had standing room only on the 19th, so I am going to do that presentation one more time in live online format. Feel free to come to that presentation. I will discuss Nevada and a few other metros in that presentation. There's just not enough time to discuss every single metro at this point, in the questions. What else? Any more questions? Have you considered the unique advantages of buying Oakland apartment buildings that have rent-controlled units? The answer is, Trevor, I do not understand rent control well. My partner hates rent control and would never buy in a rent-controlled area. So that is the only point of reference that I can give you. What is the exit process for an investor? Lakshmi asks. Lakshmi, the answer is your money is not liquid. Now, if your apartment complex is doing well, yeah, the other investors will buy you out in a heartbeat, but they probably won't give you the exact value that they should be giving you. So you'll always have to give them a discount. For example, we have an investor right now in one of our projects in Dallas, and the project is doing really well. They're distributing 12% cash. So he wants to get out because his mother has cancer and he needs money. And while everybody wants to buy his shares, nobody wants to buy it for the true value. So people always want to give him a little bit less than that. So your money is a little bit illiquid, and you don't really have access to that money until the project is sold, which typically happens in 3 to 5 years. Now keep in mind, you do get cash flow as you go, so it's not all bad. And you do have the ability to sell it, but you may not get the true value of it if you sell it. Matt says, how much are typical investment amounts for individual investors in our projects? Matt, for our projects, $50,000 is the minimum. Now, once in a year, we do a project where $25K is the minimum. Chicago is not that project because it's an expensive one. How often is cash flow distributed to investors? We distribute quarterly. Sometimes you get people that distribute monthly, but we find that the administrative overhead is huge, and in the end, the investors pay for the administrative overhead. So we do quarterly distributions. So retirement plans can invest in syndications. In fact, if in Chicago, the largest single group of investors are self-directed IRA plans. I believe that we have 11. What is your management fee? Our management fee is essentially different pieces. So we take 30% of the value. We charge a 1% of total cash management fee. So Chicago should have somewhere around $2 million a year in rent. So our management fee there is $20,000. Keep in mind that's a very low number because Ethan, the Chicago partner who keeps that fee, he has to travel there from the loop to that complex every day, 5 days a week. And he often does it twice a day. So $20,000 is a very, very low number. Any more questions? Wow, I love the question bombardment. Here we go. What is the average cash flow return rate paid to investors across your 1,001 units? So Jeff, here we've hit SEC rules. You're welcome to contact me, but I am not supposed to discuss returns in an open forum. You're welcome to talk with me one-on-one. I'll be happy to discuss those returns. More questions? All right, we are at 6:58, so I am going to end the event. We'll wait for another 10 seconds for a last question. No questions. All right, so thank you for your time. I hope you enjoyed the event and you learned more about multifamily. I will be sending a copy of this recording out to you guys. Feel free to reach out to me if you have more questions. Folks like Trevor use me as a sounding board for their investments all the time, and I'm happy to do play the same role for you. So reach out to me. We are very available. Danny says, is it safe to say returns would be less than the cap rate? Danny, that would be a horrible thing if it ever happened. The answer is no. In every instance, returns should be higher than the cap rate. At least in our investments, they should be. All right, we'll take that as last question and bid you good night. Thank you so much. Have a wonderful evening.